Hey everyone, welcome back. I'm going to tell you why you need to calm down, why you need to just take a breath, why you need to take your politics and whatever you're listening to from whatever side. This is not a side choosing video. This is to help you focus on the long term success for your retirement. And we're going to talk about the markets in perspective. We're going to put them in perspective right now. We're going to do this with First Trust data. First Trust is a massive investment firm. They're one of the best, arguably the best of the best out there. I could never have done this research on my own. I focus on client planning, accumulating client information, where they're at right now, their goals, and taking logical steps to achieve those goals, get the retirement that you want, the future that you want, the wealth that you want. I can't put all this data together, so I got to rely on someone else. We're going to use First Trust data. This is a little bit different than my previous videos, so just listen. This is going to be really valuable. First one. Since 1970, you can see there's been the crisis du jour. Crisis and events happen all the time. What's different now is the way that we're getting fed the crisis and events and who's feeding it to us. Social media became intense right about here. 2011, 12, 13, 14. But from all this time, we just got it from newspapers and the news. Maybe a little bit of internet blogs along the way. But there's always a crisis that's going to happen. But as you can see here, this blue trend line, regardless of the crisis, there's some ups and downs and ebbs and flows. The market continues to grow. And what I mean by the market, let's clarify. What I mean by the market is all of the publicly traded companies utilizing goods and services and their future earnings continuing to grow. There are periods where there is non-growth, but there are more periods of long-term growth. So there's always going to be a crisis and event. There's never going to be a quiet time. And especially now with social media, it's only going to get worse. Next, staying the course. One of the biggest questions is, when do you get back in? When are you going to pull out? When are you going to get back in? It's really, really hard to choose when to get out and when to get back in. And if you are selling right now, Warren Buffett said this, if you're selling right now, you shouldn't be investing because you're investing and selling based on emotion. This chart shows those orange intra-year declines. Within the year, there's always some sort of decline. That's what you're seeing right now. I'm going to move in a little bit closer because it's kind of small for me. But right now in 2025, you can see there's a 10% decline. But let me give you an example. In the year 2020, COVID year, there was a 20% decline. The market ended up 16% on the year. In 2021, there was a 5% decline throughout the year. The market ended up 27%. There's always some sort of intra-year decline, but the majority of the years, the market ends up. Staying the course is your most successful modus operandi for long-term investing. This chart goes back to 2007. It's comparing different asset classes, stocks, gold, 10-year treasuries, the consumer price index, home prices, cash, and oil. And since 2007, almost 20 years, stocks are the best performer. Gold is the second best, 10-year treasuries, consumer price index, home prices are at 4%. I mean, stocks, the long-term growth of goods and services seem to be the best method of accumulating wealth for the majority of people. Not everyone. There are some people that find different ways to do it. But for the majority of us, you just got to be able to weather the storms like we have right now. History of US bear and bull markets. there's a lot of blue. Blue means bull. Orange means bear. The comparison of the growth in the bull markets to what there is in the bear markets is almost not even comparable. But yet people magnify the orange, the bear markets, to be something more substantial than they really are. There are far more growth or bull markets than there are bear markets. It's just simple as that. And that's historic. This chart goes back to 1942. 1942. Most of you listening weren't even alive. Most of you listening to this, you weren't even alive yet. And this chart goes back, and there's way more long periods of earning than there are periods of non-earning or losses. This is an interesting one, missing the best days of the market. If you just stay in the market from 1979 to March 31st, 2025, if you just stayed in the market, $10,000 invested over that period of time is $1.6 million. If in that same period of time, December 31st, 1979 to March 31st, 2025, it's a really long period of time. If you missed the 5 best days in the market, your return decreased by $600,000. If you missed the 10 best days, your return decreased by $900,000. What this is illustrating is the best days in the marketplace are the most valuable days. And if you are out of the market, you're trying to time the market, you miss those good days, it destroys your portfolio return. Just staying invested is your best plan of action. You can see here, there has been, since 1926 to 2024, almost 100 years, 98 years. It's just shocking. It's just shocking. There's been, of 100 years, 73 of them have been positive years. 73%. And the average positive return in those 73 years is 21.5%. There have been 26 negative years, and the average negative return is 13.4%. Not only are there substantially more positive years, 3 times more positive years, but those positive years at 21.5% on average is a substantially larger return on the upside than the downside. But people, again, worry so much about the downside. And then the 99-year average annual return is 10.4%, and that's of the S&P 500, the 500 largest companies. This is just crazy. Probability of positive returns, if you look out 10 years, 97% chance that you're going to get positive returns over a 10-year period. If you look at a one-day return, if you look at a day-to-day, 53%. That means a day up, a day down. 1 month, 62%. 3 months, 69%. 1 year is 77%. Since 1937, 77% of the 1-year returns are positive. It's nuts. This is an interesting one because a lot of people are talking about the volatility in the S&P 500, the giant swings in the marketplace. And that's number of days with greater than 1% moves. Because volatility is not risk. Volatility is just price swings. Could be up, could be down. Volatility just measures the width of those swings. 2025, there's only been 21 days so far. So it's a short year. So pretty volatile. 2024, last year, there was 50 days of 1% swings. The market had a great year last year. 2021, there was 64 days. 2022, there was 122 days. 6 times as many 1% moves in 2022 as of 2025. We're a quarter of the way in to 2025. So let's see how it shakes out. If you multiplied that by 4, you're sure going to have less volatile days than 2022. Less volatile days than 2020. So volatility right now is nothing unusual. S&P 500 index performance during and after extreme down days. This is just showing you The performance is the best after extreme down days. That after really bad down days, like let's look at this. 1987, there was a one-day return of negative 20%. Black Monday, I bet that was. 1 year later, it was up 23%. 3 years later, 11%. 5 years later, 13%. 10 years later, 15%. From these worst days, the market flourishes historically. Some of these really, really bad days, 2020, March 13th, 2020, in one day, the market was down 12%. You remember that day? I remember that day. I had just started my business. I wasn't even a year in. I was like 6 months into my business. 1 year later, the market was up 66%. 3 years later, 18%. 5 years later, 18.7%. I'm not scared of the down days because historically, we're going to see some good days. In the history of market corrections, we're going to end on this one. 5% or more happens about 3 times a year. We talked about that. 10% or more happens about every 16 months. That's kind of what we're in right now. We haven't had a 10% down one for a while. We had 2 great years in the marketplace. You can see that this stuff that we see in the short term shakes itself out. You should not be excessively concerned. This is all real data. You can check this. You can look at this. If you want to see a copy of this, make sure to send me an email. I can send you a copy of this if you want to see a little bit easier. But I mean, what else do you want? Thanks for listening. I appreciate it. I know this was a little bit different format. If you like this, comment below. I know that you're going to come up with some place to argue about all this. Yeah, but all that is coming from a political motive. You cannot let anything positive come out of what's happening politically. And this happened with Biden. This happens with Trump. It happens with Obama. It happens with Bush. It happens with everybody. If you're on the other side politically, there will always be negativity. But when you think about past politics, you start to evaluate large companies continuing to grow over long periods of time. That's what we're investing in. Good luck trying to argue that. Thanks for listening. I know I was kind of tough on this one, but I have to stress people are making ridiculous decisions off things that in the long term do not matter. They do not matter. Like and subscribe.